Let's talk about delinquencies. I really want to bucket this kind of into three buckets. There's credit card delinquencies, there's auto loan delinquencies, and then there is housing delinquencies.
If you zoom in right now on delinquencies, it looks like a shelf going upwards like this, or a
Yeah.
slope going upwards meaningfully. And you're like, oh my Lord, we are in for a hell of a storm here.
Let's talk about consumers and more specifically delinquencies. I really want to bucket this kind of into three buckets. There's credit card delinquencies, there's auto loan delinquencies, and then there is housing delinquencies, because I think there is a story going on that most people miss. In order to have this conversation, we do it with Taylor from Life Goal Investments. Man, how you doing?
I'm doing great. This is an interesting one because this is where statistics can be spun to tell one side of the story or the other side of the story. If you zoom in right now on delinquencies, it looks like a shelf going upwards like this, or a
Yeah.
slope going upwards meaningfully. And you're like, oh my Lord, we are in for a hell of a storm here. And then
Yeah.
if you zoom out, you look at it and we're basically right in line with historic averages. So it's how do you want to look at this and how do you perceive data? Because how you interpret this could tell two massively different stories.
Yeah. So let's start with credit cards. I think there's a couple of things the average person is being told. One, we have over $1 trillion in credit card balances, right? Which
Yep.
is a record.
Yep.
We also have seen some numbers about rate of change being significant. Again, your total zoom in, right? Let's create the
Yep.
scariest story possible.
Yep.
And I guess lastly, credit card rates, damn, are over 20%. So,
25-ish. Yep.
oh,
Crazy.
it's crazy. So when you look at the credit cards, balances, delinquencies, what do you think that means? Do you think it means that the average consumer is out of cash and they're just running amok, or do you think there might be a different story out there? What do you think about credit cards?
The $1 trillion number doesn't scare me. And I sound like an idiot saying that, right? $1 trillion in credit card debt doesn't scare you. It doesn't. When you zoom out and you look at it relative to overall economic output, it's right where it should be. It's right where historic norms are on a percentage basis. So the 1 trillion does not scare me. What scares me, to the point that you just made, is the rate of change. So we came from extraordinarily suppressed levels of credit card delinquencies because everyone got a $1,200 check and then they got another one, right? And so that was just stimulus money. So what they did with that, good for them, is pay down their credit card debt. And therefore, we went to historic lows on credit card delinquency. But what you've seen is a meaningful pickup from that point. Now, the meaningful pickup has only gotten us in line with historic norms, but the direction is not necessarily comforting. And you look at this, and the surprising thing from an economic standpoint is you look at it and say, normally credit card debts don't spike during a time with extremely, extremely low unemployment. But
Yeah.
that's exactly what we're seeing.
Yeah, I think what's going on with credit cards, there's so much in the economy that is going to be really turn out to be just regression to the mean. I think we had artificially low balances and low delinquencies, which also probably means credit card companies were underreporting and kind of working with people.
Yep.
And I just think all of that's being cleaned up. Visa, MasterCard, Discover, all these folks are just, doing their job, frankly. Discover specifically came out with some really bad numbers and had to increase loan loss reserves, I think last week.
Yep.
And but to your point, when you zoom out, we're kind of right in line with historical averages. And if I'm right, what does that mean? It means we're going higher,
Yep.
right?
Yep.
That's what regression to the mean kind of indicates. So I think we're going to go higher. I too don't think it's some kind of earth-shattering thing. I think there's a lot of consumers who frankly don't know how to spend, don't know how to save, will get in trouble, will go back to the credit card companies, will do a loan workout. And it's just, it happens all the time. It's just that we're coming off a low base. So this, that shelf that, the whatever reverse cliff, it just looks shocking if you zoom in.
Yeah, totally agree. And this coming from a financial advisor who profits from people investing money with us. If you have credit card debt, don't invest. Don't invest.
It's a 20%, 25% return. Pay that shit off.
Correct. Pay that down as quickly as possible. But here's the reality of what comes with that. When you think about opportunity cost, okay, people can pay down credit card debt or they can invest in the market. right? Obviously, everyone would rather have their money invested in the market because that takes stock prices higher. But if all of a sudden they're looking at this and saying, hey, I'm actually going to sell some of my stock exposure to pay credit card debt on the other side, what does that do to the market at large?
Well, let's flip over to cars
Yep.
because I think there's a real story in auto loans. And I think it's the exact opposite of housing. We'll get to housing after autos.
Yep.
If you were paying attention in the auto market the last couple of years, prices for product went up. Used cars went up. And I mean, there were, I don't know, TikToks and, stories and all this of people with $1,000 car payments. The only reason, in my opinion, that those were approved was because people weren't spending on other shit. Now that all these things have kicked in and life has smacked you in the face, and I say this as an idiot who bought a $40,000 car when he made 25 grand. So I get it. I've been that stupid before as well. And I just think they're looking at their car going, you know what? Too hard. Can't pay it. Got to do other things. I think the car is going to be the thing that goes.
Take
And they'll
it.
just take it.
Take it. I'm not letting the roof over my head go. My family's got
Exactly
to have
what's
a
going
place
on.
to live. We got to eat. We're not going to let those two things go. Therefore, take it.
And there's
Right?
optionality today. Yeah.
That's it. That's it. It's opportunity cost. What can I afford and what can I afford to do without? And a car,
Yeah.
unfortunately, might be that. The reality is the numbers were shocking. Shocking.
Shocking.
Are shocking. Right now, the average new car in the United States, and this is going to be within a couple $100s of the exact right number, is $48,800. The average household income, this is not individual income, household income is about $72,000. What? How do those numbers equate? So that makes the average car payment somewhere in like that 780 range,
Yeah.
right? That is the
It,
entirety of your household income basically going to a car payment. That's not reality. And a lot of this is a function of the onerous supply chains that we saw happen via COVID, semiconductors. If you look at EVs use an exorbitant amount of semiconductors. And when they're not there for purchase, being the semiconductors, those EVs can't be constructed. And therefore, there is a supply constraint on that. And that forces prices higher. And that happened around not just EVs, which are the biggest proponent, but also cars in general right now. Lane shift and things like that, where they lane assist you, that's all chips. And so
yeah.
if they can't get their hands on the chips, that creates a real issue.
Yeah. And the other thing I saw was really interesting. Tesla cars in the used car market for the longest time, you'd almost get a premium for
Yeah.
Teslas. They've been
Buy it, sell it later at a higher price.
yeah, it's wild, right? That is not the case anymore. Tesla specifically, and I think this is true for all EVs, have seen a noticeable downdraft in resale values.
Yeah, you want
And
to know why? I just talked about this in the last episode. Tesla now has inventory on their website. You
yeah,
can go on their website and say, "I'll buy a brand new one for $48,000, not the used one for $47,900."
exactly. Yeah. Yeah, so I think what we're seeing and also let's talk about cars. A lot of people bought that third toy, right?
Yep.
And to your point, I think what we're seeing with auto loans when because I say this as a kid who was probably 12, 13, 14 at the time, watching his mother at a kitchen table try to juggle delinquent bills because it was 80s sucked.
Yep.
And at the time, the most important thing to my mom was the house. Wasn't the car. We didn't have cell phones then, but it wouldn't have been the cell phone. It wouldn't have been these other things. She would have cut cable. She would have cut, everything.
Yep.
So to fight and stay in the house. And I think that's going to shock a lot of the crash bros and doomers because if we roll into housing, we have seen again. Go ahead.
Can I cut you off 1 second? Because I want
Yeah,
to talk just that one more thing on Tesla. The other
please.
thing that's important with Tesla and EVs in general right now is that we don't know how far forward this tax credit that you
Oh
get when you
yeah.
purchase a new EV is going to last. So right now you get a $7,500 tax credit. That's like getting a $7,500 reduction on the price.
Yep.
And we don't know if that's going to proceed into 2024 and forward. So that'll be another interesting thing to say, okay, if I can buy that $48,000 car, which is kind of where the Tesla ballpark is, and I can take a $7,500 tax rebate on that, and all of a sudden I'm at a $40,000 car, that's stomachable. But if that's
Yeah.
not there anymore, boom, that directly inflates the price of that car. So I
Absolutely.
didn't mean to circle back.
No, it's
Continue on
great.
your housing, but I think that's something that's important that the market has to realize. And I think I keep saying proceed, but let me say something first. I think what's interesting there is you could get a run demand wise from now until the end of the year on EVs potentially. You could get people running out and saying, I'm going to purchase this now because I want that $7,500 tax credit. And I don't know if it's going to come next year. And that'll be interesting to see how that plays out in earnings, et cetera, and how many cars are moved on the EV market between now and year end.
Yeah. I actually thought I read something, but I don't know for certain. I read so many articles. I thought there was talk about making the $7,500 credit actually easier in 2024, but I may have read that.
There's just a lot of outstanding question marks in general. It's not clear as to where
Not
things
done
are
yet.
going
Okay.
moving forward. Yeah.
There you go. Well, let's get to housing delinquencies because again, I think based on who you talk to, delinquencies again, 30-day delinquencies are up noticeably. 90-day delinquencies are down a tick. And again, if you don't know housing, 90 days is where you're considered seriously delinquent. That's when a foreclosure could start. 90 days, no
Yep.
sooner.
Yep.
So that's significant. 30 days are up, 90 days down. I just think with a blended interest rate of 3.6%, yes, I know rates are 8% today, but most people bought their homes, months, years ago when the rates were
Yep.
lower.
Yep.
Families are going to sit around the virtual kitchen table, if not a kitchen table, and make hard choices. And this is if a recession happens. If a recession doesn't happen, then this doesn't play. But if we do have a recession and there's job losses and families are like mine, who my dad was unemployed, my mom was a stay-at-home mom, and you got to juggle and make tough choices. Unlike the Great Recession, this is exactly opposite of the Great Recession. And I know a lot of young people don't have another frame of reference, so let me give it to you. The house, and specifically the mortgage, is an asset today.
Correct.
Your mortgage payment is less than rent by a mile.
Yep.
For some of these people. And for some people, the payments are so low. If you have a 2.8, 2.9, 3.1, you can pay it with unemployment. If you're looking at your household kind of outside in, right? You got your 3 cars and you got your house. Guess which goes first? It's the cars.
Absolutely.
Not the house.
Absolutely. And they should go first because it's not an absolute necessity. And not even looking at that, but thinking about the underlying interest rate on the cars is significantly higher than that of the house as well. So just making financial, decisions on interest rates, which are important, that leads you to the same conclusion.
Yeah. Yeah. Again, I think, and the other thing that's going on is values are falling. And this is going to be very much like the Great Recession. Why did the Great Recession for real estate get so bad? Is that the debt reset, which meant mortgage payment greatly exceeded rent. So you move and your situation improves, but also the asset value, you were underwater and people didn't want to pay up. A lot of these cars you all bought are way underwater.
Yep.
There's no value there. So take the loss, get it repoed, go get a secondhand car somewhere else for, $5,000. You're still mobile.
Yep. You could still get to work.
It's a very different story. And I just think a lot of people have a recency bias, or we're so young that that's their only experience, that housing crashes, can happen this way. And it's not set up. Delinquencies are going to spike in autos and credit cards a lot more than housing, in my opinion.
Yeah. And to be honest with you, from a firsthand perspective, you just given me a little bit of education because I can look at the numbers and look at data, but like when you speak about it concisely, how you've actually experienced some of this stuff and the decisions that your family went through are like, okay, that's eye-opening. And it doesn't seem like you can make another decision. There's no other decision to be made.
Yeah. Well, you're gonna keep the Mercedes or BMW paying $1,000 a month plus insurance and let your house go so you can take your BMW and go live with mom and dad. Because think about the choice of down selecting. You don't want to live in your car. Most people. Do you want to move in with family? Not most people. Do you want to down select from a house to an apartment? Not most people. I mean, These are the choices people have. And oh, by the way, if the mortgage is an asset, you can ask your sister or your cousin to go rent a spare bedroom, for a year as you get back on your feet.
Yep. And not to mention culturally, this is we own houses culture. That's the way it works. That's not the case everywhere, right? That's not the case in Europe per se, but we want to be homeowners as Americans. And that's something that people do not want to let go of.
Got it. Well, you do an amazing job of educating people daily. I don't know how you find the time to do it, but you are amazing at it. Where can people find you?
I appreciate that, Michael. Yeah, find us on Instagram and on TikTok at Life Goal Investments. Again, just a daily 60 seconds on whatever's going on in the market and the economy.
You got it, buddy. Thanks again.